Hey folks, this is Sean Hyman from The Logical Investor. And with the markets extended, I think it's time to take another look uh, and go down stock market crash lane. um, because markets are so extended. And again, nobody will know the day or hour that it sells off, and nobody will know ahead of time what the trigger will be. Um, but because sometimes they can come out of left field. But remember what this uh, move down here felt like. This one from uh, almost 10,000 to 6,600. That fall. See the size of that fall and how great that felt and how serious that felt. Okay, now move over just a little bit to the right and look at this one compared to that one. And look at how far this price was from this 200-week moving average, which was further than all of these others, except for back here. And look at how far this one is away from this 200-week moving average, and how far it could fall just to get back to the moving average, which it will eventually surpass and go far below. Then look at what happened in 2000. You know, how far away the price was from the 200-week moving average. Again, far further than it had been in its history. So these parabolic moves seem bullish. They feel bullish, but they are deceiving. They are the worst thing that you could be in. It's like housing prices in mid around 2008, mid 2007. It's like the Nasdaq back in 2000, and the the more parabolic the move, the worse the sell-off can be. And sometimes they're quicker, sometimes they're longer. But this went from 5132 on the Nasdaq to 1108. That's massive. In 2008, which wasn't a tech bubble, but which was another bubble and overvalued point, it went from 2861 to 1493. So still, pretty much cutting in half from there. And this one was, I forget, like 78% fall off or something like that. It's something huge. Excuse me. And here we are now, almost 14,000, and you've got to come down to about 8,000 just to even get back to your 200-week moving average. But these always go well below those moving averages. So imagine this going from 14,000 to say 6,000 or 5,000, and trust me, any of that is very possible. Imagine the percent drops those are. So, but also, it's obvious how this feels right now when you're living it. Um, but and how the news is and how the analysts are, and everybody's bullish, everybody's rah-rah, and that sort of thing. And guess what? They were doing that same thing right here. So I was a broker here in Nasdaq 2000, taking 8,000 calls a day from regular people all over America and some over the world. And so I remember what it felt like as a broker. I remember what it felt like as an individual. I remember what it felt like when I was seeing my stock options shoot to the moon. Um, I remember the conversations broadly, in other words, that I was having with people. They were so euphoric, so ecstatic. You couldn't talk them out of their positions. It finally got to a point where I couldn't talk my broker friends out of their positions. And when it got to where it was even affecting some supposed professionals, which again, brokers are professional salespeople, they're not professional market and stock analyzers. There are some that are, but by and large, they're not. So they're taught to bring assets in and retain those assets. They have two goals, as does any salesperson. And so, and then people that thought, well, I'll just ride it out. Okay, so you ride it all the way down for several years, and then you ride it, over for about another decade or so. But seriously, this was in 2000, and when does it come back over here into the same territory? 2014, 15, and it doesn't even really notably get past that until, call it 2017 or 18. So are you willing to wait almost 2 decades for your account balance to come back to where it was now? I'm not. So that's another reason why we don't buy bubbles. We don't buy overvalued stocks. They have further they can fall, and when they do come back, they don't come back near as fast. So they pop hard, and then even this rally here, the rallies from 1100 to 2800, which sounds great until you realize it's got to make up for when it went up to 5100 years ago, many years ago, and then it goes down again, etc. So here you are, wave 1, 2, 3 is probably up to here, 4, and then we're in 5. Now, how do the masses think in wave 5? And also, by the way, in wave B as well. Oh, it can never get any more rosy. I mean, the skies have parted, the sun is out, the M&Ms are falling from the sky. I mean, it's just an amazing thing. As far as how it feels, and people confuse and equate how they feel about something with how it actually is. Their feelings actually deceive them. And so if you feel some way long enough, it will change your thinking. And just because your thinking is a certain way doesn't mean it's fact. It just means it's your thinking. So I have lived through and avoided this bubble and this bubble because of knowing. And back here, I only knew technicals. I didn't even know fundamental analysis. And here I knew fundamental. I mean, when I say I didn't know fundamentals, I knew the basics of fundamentals, but I didn't know fundamentals, great and in depth. Now, coming over to here, I knew all kinds of stuff, fundamentals and technicals and sentiment and things like that, and that knowledge has grown through the years. So, these bubbles can be massive. So let's look at the other indices, and then we're going to look at some popular stocks during those times because I want you to get the full gravity of this. So the Dow goes from 11,750 to 7,197 before it's all said and done in the crash 2000. In 2008, it goes from 14,198 to 6,469. So again, when you think that the market's dropped back 5 or 10 or 15% and it's a buy, I want you to think about these things, these huge drops. Look at how far the price is extended away. Look at this, the sell signals on the MACD. Look at how the MACD histogram is dropping off. Look at how the RSI is dropping off. All kinds of warning signs there. The S&P 500, 1553 goes to 768. And it does this over, and this was over basically a few years in this one. This one was over a year, so it didn't take as much time, but it felt like you just came on the downside of a roller coaster because of how fast that spread out over a year. So this one was frustrating to investors because it takes so long. It's like death by 1,000 cuts. This one scares the pants off of them, much like this one did because of how fast it happens. And it wasn't as fast as this one, but it also went deeper than this one right here. So from 1576 to 666, a very bad number. And then you get your next 5-wave rally, and look at how far the price is extended away from the 200-week moving average. Certainly further than it was here, and I would argue at least on par or further than it was back here. I'd probably have to go to a log chart or something to get the exact same look, but RSI diving off, selling volume starting to pick up. You almost got a sell signal there, which is right there. MACD histogram hooking over. All the signs are there for anybody who wants to see it. Small caps. What did they do? IWM, didn't really get its start until after part of that crash. It went from 39 to 25. Over here is where it was in for a full crash from 71.93 to 28.92. So again, that's from 71's almost 72 to say call it 29. And again, where are small caps relative to their 200-week moving average? And by the way, look at what happened just in this one little 30-day downdraft from 167s to 94s. Um, and remember, these will all go well below their 200-week moving averages before it's all said and done. They always do. Um, so just the major averages go, go nuts. Okay, so let's look at, and we probably will have to go on a log scale for this one, I think. So let's look at Apple. So people think, Apple can't fall, and Apple, would do just fine in a bear market and things like that. Well, let's see how it panned out. So again, there's a ton of splits here that have happened through the years. So these are all split adjusted returns, but think about what the difference is between $1.15, almost $1.16, and 19 cents, not quite 20 cents. Think about the percentage move that is. And by the way, it still suffered over all that period of time. Now, I could say it probably stabilized and went sideways a little bit sooner than others. And of course, its survivability factor because of its cash hoard is great. But just because you have a lot of cash doesn't mean your stock price can't collapse a lot. What it does mean is after the recession and stock market collapse is over, your stock will come out the other side and come back up. But it doesn't save it from having massive retrenchments lower. So in 2008, it went the equivalent of, again, split adjusted, so the number at the time was way bigger, but $6.25 to $2.40. Imagine what percentage drop that was. So again, that's huge. So let's look at another one that people have a lot of confidence in these days. By the way, look at the bubble. Um, by the way, long, boring ranges break out into long, strong trends. So back here, nobody wanted Microsoft, and here they can't get enough of it. And what's amazing is you can't get them to buy enough of it at 230 and 240, but you couldn't pay them to buy it at 17, 24, 50, etc. That's the way that stuff works. Like Bitcoin, you can't pay them to buy it at 3,000, but they can't get enough of it at 30,000. Again, another bubble. So 1999 2000 crash in Microsoft goes from 38s to just under $13. Think about what kind of move that is. From 27s to 11s over here. Think about what kind of percentage moves those are. Now again, this one's well capitalized enough, much like Apple, to where they're going to survive the crash and any recession and come out the other side. But the reason why you want a lot of cash on the sidelines is because would you rather be, and I'm not saying we're buying Apple or Microsoft or whatever, but if we were, wouldn't you have rather have bought it at say 12 or 13 or 14 or 15 versus, closer to 30? So some massive money can be saved from dodging a lot of the bear markets, and massive money can be made by getting closer to the bottoming phases, which nobody will catch a bottom, but you can certainly catch massive, massive, massive percentage discounts off of its highs that can help you a lot. All right, so let's look at Facebook, which Facebook was not even around for either one of the last two crashes. But look at its bubble. Price up here, 200-week moving average here, RSI slumping, MACD slumping and looking negative, the MACD histogram's negative, etc. So it hadn't even been around long enough. Amazon, again, you got a massive, massive bubble up here. Up here, you're at 35.52. Your 200-week moving average is down here just above 1,800, maybe 1,900. So it's going to fall massively just to get down to that. But again, they go well beyond their 200-week moving averages before they stop. So could you imagine if this went from 3,500 to 1,200 or something like that? Could very, very well happen. So again, because of all the splits and different things like that, we need to go back to the log chart. So here was your run up. Amazon could do no wrong and goes from split adjusted 1 to 113. But, and by the way, how many bought it down here is very few. Most of the people that would have bought it in that run up would have bought it right in this latter half of it. And so it goes from 113 down to 551. Let that sink in there for a little bit. How big of a percentage loss and drop as that. I mean, that's most of it right there. And most of the people that bought anywhere in all this, they gave up all their gains and went into losses as well. In 2008, it went from 101 to 34.68. So again, massive price change difference there. I don't even let's see. Netflix wasn't around for the 2000 crash. It was around for '08. So from 43s to 754, 43s to the sevens on Netflix. Google, again, another company that is well capitalized, fundamentally strong. Wasn't even around for the 2000 crash, and did initially zip up. But when it had its crash in 2008, what did it go from? 373 down to 123. So think about how big of a drop off that was. Okay, let's look at another one that we'll look at Warren Buffett's A shares, which is back here was $80,000 a share. Today is $354,000 for one share. So people would say, well, Berkshire Hathaway, I mean, it's such a fortress, and hey, it's got the Oracle of Omaha at the head of it. That stock surely can't go down. It's got to be bulletproof. And I see this on value forums all the time, and they're shocked when I go back and show them the long-term charts and show it how it dropped. Now, granted, it didn't drop as bad as others, so relatively speaking, it was better off. But it's still overcut in half from 84,000 to 40,800 a share before it was all said and done. That was in the tech bust and .com bust and things like that, internet bust. And people think, well, what'd that have to do with Warren Buffett's stock? I mean, he wasn't in any of those sectors, and that's true. But the outflow still affected his stock to where it cut it in half. Here in 08, you got it going from 151,000 a share down to 70,000 a share. So again, huge. And even in this most recent one, you had it go from 347 to 239 in the most recent drop. So that's Berkshire Hathaway, probably that and Apple being two of the more bulletproof companies out there as far as cash on their books and different things like that. All right, let's look at a well-known company, GE. So GE, and again, I'm still on the log chart, so it'll look a little bit different, but that helps me to magnify and bring about the older stuff and make it to where you can see it easier. By the way, this is a very fundamentally flawed company these days. Massive, massive debts. I think they started reducing it, but at the time that they started reducing it, it had like 110, 120 billion dollars worth of debt, and they have brought that down some, but they got a long way to go. So it's fundamental crap right now. But nonetheless, it was one of the bigger stocks that went up in the .com bubble, and people were like, GE is a great stock. It's a conglomerate. It's in most sectors. So it's almost like its own mutual fund. That can't fall off. And it went from 32s to 11s. And then on this one in 08, it went from 26s to just shy of $4 a share. $4. So massive. And by the way, bubbles pop. So again, here's your bubble up, and here's a massive elongated ABC that erased most of the move up, and most certainly erased where most people would have ever been in this stock, because this it doesn't even get usually good news media attention until well into wave 3, between waves 3 and 5. And then it didn't do much of anything for a good number of years, and it's still second wind. I mean, 11s today, and it's been as low as 5s not that long ago. So that's General Electric. So now let's just, for kicks, let's just look at some logical investor stocks. Because even though they're fundamentally sound, like an Apple or a Berkshire Hathaway or whatever, they take their lumps in those times as well. And so it's why you want to have the cash to have large, wide averaging downs. So EWW went from 11s to 4s, but then quickly rocketed back up to 13s, which none of the other stocks that I showed you did that, and then eventually went on to 50 a few years later, and even 63 later on. So that's something that you didn't see with any of the others. LPL wasn't around for the crash of 2000, but it was for 08. Went from 31 to 5s, but then quickly V-bottomed and went from 5s back to 21s. And when I say quickly in the grand scheme of a 10-year chart, meaning that within the span of a year and a half, it goes all the way down, V-bottoms, and snaps all the way back up. And so in under a year, call it half a year, 8, 9 months, whatever it is, it goes from 5s to 21s. But you weren't seeing that with a lot of this other stuff that I showed you. So, so again, that was a good sign there. So Canon went from 19s to 9s, but then again, fairly quickly rebounded over the next year or two back to where it was before. Again, you can't say that for a ton of stocks. In 08, it goes from 37 to 13s, but it goes from 13s up to 35s, recouping probably 90% of that in fairly record time. So do you see why we deal with very defensive stocks? Now, KHC has been around for a long time, but they, I can't remember if they went private and then back public or reorganized or whatever. They did something anyway to where the Kraft Heinz as you know it, or I think it was the merger between Kraft and Heinz, I think. Gosh, it's been so long. Anyway, so that only starts from 2010, so we can't really consider it as one. So let's look to ENI. So ENI probably wouldn't be fair to say because it didn't have the the full whatever it would have been. It started trading at the latter part of the crash of 2000, so from 9s to 7s. But I wouldn't count that because had it been trading or something like that, it would have been up here and would have still taken a pretty good little lump. But even from there, recoups all that from what little bit of history it had there pretty quickly. In 2008, it goes from 44s to 16s. So you can see it is easy for stocks to go down significantly into the single digits, low double digits, that sort of thing on a serious drop there. But also, what does it do? It pops back up from 16s to 31s pretty quick, and over the next few years goes back to 4073, which was almost this high here. So again, you find that there's a kind of a staying power to what's considered value stocks and things like that. Their ability to snap back, so they can go down with the rest of the market, but they tend to be some of the first to snap back along the way. And you earn dividends. So while everybody else had an S&P 500 index fund that earned under 2%, and they own tech stocks that either didn't pay a dividend or paid a paltry one, you were earning 3, 4, 5, 6, 8% dividend yields along the way while you waited as well. Okay, so silver. Some people I tell you what, instead of looking at SLV, let's go back to actual silver futures itself, because I can show you because that contract was invented or that ETF was invented after the crash of 2000. Okay, so people will say, well, I thought silver and gold and stuff like that's supposed to be defensive. How can they go down? And the thing is, they can go down. This went from 7s to 4s. This is silver per ounce. But look at what it does once things start turning around and bottom. It goes from 4s to 8s. Okay, that's bigger than it was at the peak of the last one. And soon takes off. After that, it goes to 15, 21. Does take a big dip here, but then goes to 49.82 before it's all said and done. So that's the power of. So that's why I say if value stocks and defensive assets don't go up in the crash, then they tend to bounce back and snap back a whole lot faster than any other type of stock, including the S&P 500. After the crash is over. So in 2008, it went from 21s to 8s, but then rocketed higher then it, double of what it had ever been before the crash. So that's why it's a defensive asset. Not because stocks go down and it can't, but because when it comes recoup time and recovery time, these things can have the ability to rip roar at a much faster pace than your average typical stocks. So that's silver. I think GLD. I think has been no. Actually, the GLD contract or ETF hadn't been around as long. It has in 08. It went from 97 to 68, which again that was one of the smallest percentage falls compared to everything else we saw. But then it goes on from 68 up to 185. So here was the 08 crash, and here's what it's doing like a year and a half later, 185 versus 97. All right, now let's go to the actual gold per ounce so you can see what 2000 crash looked like in gold. So gold really wasn't doing a whole lot before the 2000 crash. It did bump up some, towards the end to 337 an ounce, and it went down to 253, 255 an ounce. But then once it starts popping up, it goes back to 384 fairly quickly over the next couple of years, far higher than what it was before the crash. And then it goes to sevens, 1,000, 1923 before it's all said and done. So again, that's why value assets are so superior, because they're in the end they are very defensive. They can initially fall like everything else, but they rebound like a beach ball held underwater and let go. And when I say that, meaning rocketing over time. Like these are long-term charts, but for instance, this is XOP, and it went from 254 to 79. But when the recovery starts happening, what's it do? It goes from 79s to 232, so it recoups probably 80-90% of that. Does dip a little bit, but it's shallow, and then goes on to 306, which was far higher than what it was at the crash high. Well, that's certainly not what you were seeing with the with the major indices, because if you had a S&P 500 index fund that peaked here, it took you all the way over to here to get back break even, and then what you did, it still took another tumble and took you to back here. So if you were in the 01 crash in the S&P 500, you spent from 2000 to 2007 just getting back to break even. So you spent 7 years getting back to break even, not to anything higher, and then it dipped on you again, and then it took you to call it 2013 or 14. So it took you about 14 years just to get back to break even again for the third time, first time here, second time here, third time here, before it goes on to something bigger. NASDAQ, the ones that everybody wants to eat up so much, again, 5,000 to 1,100, then it goes to 2,800, still only about a little over half of that, then dips again back to 1,200, and then doesn't come back up to 5,000 something until, call it 2015. So again, another 14-15 year wait to get back to where it was before. But that's not what you're seeing with our stocks. So we're not in PPLT right now. But platinum in 2000 went from 640 to 401, but then quickly ratchets back up over the coming months to year to get back to that, and then goes to what is this, 900, 1,000, 1,300, 2286, and then it starts its big ABC downtrend after that. So again, another massive one. In 08, it goes from 2286 to 752, but then what does it do? It V bottoms and heads on up here to 1976. So again, very, very different picture than what you're seeing with most assets, right? All right, so we already did XOP. So let's just look at let's look at FXY, which FXY hasn't been around forever, but it was basically created basically just before the 08 crash. And what did it do? It went from 80 to 130, over the next. This was in before '08, and this was what 2011 or something like that. So a few years, it went from 80 to 130, while so many other assets were crashing hard. CAH, let's look and see what it did. In 2000, it went from 28s to 12s, but it quickly goes up further than it was at the crash, again in far faster time, from 12s to 39s. Now, you're not able to say that about most tech stocks, internet stocks, S&P 500, NASDAQ, things like that, but you can say that about great companies that have been, value stocks. And so it rips up to 39 and stays at a fairly sustained level above its old crash level for quite some time, with a couple of dips in there along the way. And then finally, in the '08 crash, it goes from 39s to 14s. But then what does it do? Over the next year or two, it's back, at about 38 or so, which is pretty much about at these high. And then it busts through that and goes to 77 before it's all said and done the next couple of years thereafter. So what I'm saying is, we may have to. We've been spoiled. We've had some massive gains. We've had some massive appreciations in positions that we held for literally days, weeks, and months sometimes. And we've mainly focused on the stock appreciation side because appreciations happen so quickly that we've gotten some dividends, of course, but not near the dividends as if we had held something for quite some time. Through these bear markets, we may be holding something, again, for sure in that 2 to 4 year average time window, and some might go into a 5th or 6th year. But if you do, you would have appreciation plus all those years of all those dividends as well, which again, if you were just parked in cash, you wouldn't have reaped that much. So again, CAH. So let's look at IBM, another one of ours. Went from in 2000 crash from 90 down to 35, and then it quickly goes back to 66. So it's already back up about half or 2/3 or whatever of what it lost there. Did meander for a while over the next year or two, but then goes back to 90 here. Again, far sooner than what the NASDAQ, S&P 500, etc. experienced. Then it dips, and then it goes on to 161, and it's held these much higher levels since before that. And again, in 2008 crash, it went from 90 to 48, but then went up to 161 in the years after that. Okay, so that was IBM. Let's look at GDX. So GDX was not created before the 2000 crash. So it went in 2008 from 52 to 14s, but look at what it did. It quickly turned around and V-bottomed and made a beeline back for 51.39 in record time, and then went on to 62.70, which was far higher than what it was at the crash before it finally topped out and went down again. So again, that's another reason why it's a defensive asset, because when it's all said and done, and a couple of years later, all other types of assets are still licking their wounds and can't get up to their previous levels by a far stretch, and it takes them 5, 10, and 15 years to get back there. You're seeing that happen in 1 and 2 and 3 years with value stocks. And so let's see. We looked at IBM. Let's look at now ExxonMobil. This one was obviously back around then, so it was at 26 at the high, went down to 16s. So again, bad but not terribly bad, and then fairly quickly over the next year or two, gets back to those highs, and then rips all the way up to 62. Far cry from 26s, its previous high in the crash of 2000, huh? And then the crash of 2008 happens, and sure enough, it has another big pullback from 62s to 36s. It bumps up to 51s fairly quickly, does pull back to 38s, but then it goes 61, which was almost the equivalent here, and then it goes to 78, almost 79, far higher than what it was here again. So, and imagine, in some of these stocks, if you're able to average down in those times and have very wide averaging downs, um, you don't have to wait for the full cycle to come back around to the old highs for you to be making money, like the people who were in it wrote it down and wrote it back up. So keep that in mind. It doesn't even mean that our timelines will be that as long as they are for the masses because of the way we allocate money. Um, and again, we already looked at Cardinal Health. But again, there's so what do bear markets show us and tell us? They tell us that there's going to be massive retrenchments price wise. That value stocks can go down and many times do go down with the others, because if you think about it, if people are taking money, if they're selling the S&P 500 index and they're taking money out of that index, then to some degree 500 of the largest companies are getting sold all at the same time to some varying different degree. So you can't swim upstream per se. Not to say that some assets can't, because just because some assets went down in previous ones doesn't mean that they have to in this one. Because with every recession and crash, there are different economic conditions and scenarios happening that can make some act differently. But in the worst case scenarios, which is what I've just gone through and showed you with all of our positions, those are the type of things that can happen retracement wise. But notice every one of those companies, every single one of those companies that I showed you, made it through the 2008 crashes and 2000 crashes and went on to higher highs, except for the few that the instruments didn't even exist in the crash of 2000. So your confidence level should be high in your assets on their sustainability, survivability. You should expect for them to cut way back in per share price. And what that means is temporarily during that time, that means your account balance will go down during that time. But remember, you've got dividends that will be coming in that are far larger than what you'd earn in a bank account, far larger than what most people are earning in the stock market, because you're earning 3 to 8%. They're earning, a percent or two or less. So you're earning, 2 to 4 times what they're earning in interest in dividends while you wait. Then, because of the way we average down, your holding time isn't as long as theirs are, and you own better quality stocks that tend to historically snap back much faster than other popular big name companies that people have drooled over, but that are more overvalued. So the reason why ours snap back faster is because they're quality and because many times they're cheaper and in some cases more defensive. So so they are relatively defensive, meaning relative to if you own the average portfolio, the average stock, or even the S&P 500 index, you will find that you will do better off as these tank over time, because they, again, it takes, you'll be 2 or 3 years in these, and sometimes. Okay, I had to stop the video for something, so I'm not exactly sure where I was at. But anyway, the point being is that you earn more interest than most people do through dividends. It's technically dividends, not interest, but you earn more cash flow income from your stocks than most people do during that time. You bought better quality stocks and or cheaper valuations than they did, so justifiably those stocks can bounce back much quicker. And as you just saw, I just took you through every position that we've got, and you saw how they did in 2 bear markets and how they did after those bear markets. So a couple of years or so after those bear markets, you will be looking so much rosier than most people who are still got more years to go for their portfolio to get back like what it was. And when we're on to greener pastures, and again, it could be shorter time frame with that, depending on the averaging. So in bear markets, obviously you can have very wide averagings because the percentage retracements that the stocks do from high to low are sizable. I mean, you've seen those. So just know that. Expect. So here today. So like, let's just look at the overall market again one more time. These charts don't look so scary because one, you don't have the emotion and the feeling of these, and you have the you know foresight of knowing that this happens after this and that this happens after this. But during that time, you don't feel like this is coming, and during this time, you don't feel like this is coming. So it's not going to be a good feeling time. Um, it will be a gloom and doom feeling time. The news media coverage will not be good. They won't have one good thing to say about stocks. They won't have one good thing to say about our stocks. There'll be a lot of gloom and doom and woe is me and a lot of horror stories out there and stuff like that. There'll be people that'll blow up their accounts. Again, not logical investor people, but people on margin will end up blowing up their accounts because if you think about how deep those retracements are, it's nothing compared to the amplified compounded effect of those that are trading on margin. So a stock might pull back 50% or 70%, and they might lose 100%, in their account because they were trading on margin in the same stock. So margin is a double-edged sword, and it cuts deeply on the way down. So again, keep those things in mind because you will, if you think you've ever been tested with volatility, you have never been tested with volatility until you go through a bear market, which most of my people have not been through a bear market. And so that's why I'm taking so much time in pounding that about these stocks, because I want you to emphasize and see how great the retracements can happen, even on, because that was another thing I've seen on forums. Well, I'll just buy the S&P 500 because it's a diversified basket of 500 companies. It can't go down in a bear market. And I'm like, are you serious? So I take and throw a screenshot up of this chart, 1553 to 768. I'd call that a pretty sizable retracement, and that's over several years. 1576 to 666. Again, a massive percent retracement. People think, nah, stock indexes can't fall that far because they're diversified, so you don't have any risk. Here you have diversification from risk of the index and those stocks overall failing, but that's different from them falling significantly in value. And so you're going to have massive retracements. And again, think about how long the S&P 500 went nowhere after this 2000 bear market. We could be in another one of those, because usually when you have crazy returns to the upside, you're in for a season where the index doesn't do a whole heck of a lot. However, we can make pretty good headway because, again, when markets dip, what does it do? It provides opportunities to find value stocks, and then also we average down in several wide batches. So it makes it to where we can get profitable even sooner than somebody would who just goes all in at one price. So if you're new to us and you don't know what I'm talking about, one, see the email that I send you that tells you every next step to take. And for any reason, if it went to your junk mail or anything like that, and you don't see it, go to right here on the forum. New subscribers, here are your next steps after joining the newsletter. I mean, it's as plain as I can make that. So I want to make sure you don't miss it. So I wanted it titled correctly. So click on that title, and that will show you your next. I think it's 8 steps of things you can do to get geared up to to where we are. So so again, markets didn't go anywhere from 2000 all the way through to about 2013, 14 before they really took off and made up this ground from people who had been in on this big bull market here. And remember, the Nasdaq went up more, so the Nasdaq also went down more. So it went down far further, excuse me, than the S&P 500. So from 5132 to 1108 is huge. 5,000s to 1,000s. I mean, that's massive. And then this next rally, it's coming back to half or 2/3 of that, and then loses that again back to 1265. And then it's on up to you're down to 2012 and 13 before you're even back to these highs. And to get back to these highs, you got to be back way on up here. So again, it's the reason why we avoid bubbles, reason why we avoid overvalued stocks. It's the reason why I'm pickier about what we buy, because institutions think like I do. In when they're looking and the sky's falling and they got to allocate money, what are they going to allocate it to? Stuff with a lot of cash, lower debt, a lot in earnings, a sizable company, decent dividend when they can find it, things like that. So those are the reasons why money flow into our type of stocks much better after these bear markets than does the typical stock. Um, so keep this in mind because it's very, very, very important. Okay, so with that said, I'm going to go through our positions super fast because I want the bulk and the main part of this video to be on stock market bubbles and the indexes and how some of ours have performed in the past. So we sold FXB and PPLT for a profit to raise more cash for the coming bear market. So if you think about it, we don't have near as many positions as we used to have. We've locked in a ton of profits, through the years, and do not forget that when the bear market comes, because you're far better off having locked in and secured all those profits and have all that extra cash than if you'd been the normal average Joe out there, fully invested and possibly even on margin, and rode it all the way up and all the way down, or panicked on the way down, sold out, and locked in your losses and not even recouped something. So there will be tremendous value to the service in that bear market, maneuvering that with your portfolio, your 401k, etc. But just know a lot of our gain during that time may be off of the dividend income through that period, and there's nothing anybody can do about that. That's the nature of the market and the flow of the market. No more than if I tell you to jump in this river and swim upstream, you might be able to do it for just a little bit, but you're not fighting that flow forever. And so before long, you're going to be going back downstream no matter what. And so we can't, bear markets are stronger than bull markets, the pull of them, because most people are hitting the sell button and panicking and fearful all at the same time. So it's like a lot of people filing into a room one by one, but then the room catches fire and everybody tries to run for the exits all at once. It's a very different dynamic than when people were filing in. So EWW again, and these are the wave counts. Before or if we, but if these will be the wave counts unless we get a crash which can elongate wave counts, which can cause double zigzags and things like that to elongate patterns or pullback patterns or cause other bigger patterns. So there's all kinds of things if we do get a crash that can recount these waves. But the way they are right now, EWW wave 1, 2, 3, and we're in a pullback, which we expected because of the rising 200-day moving average. And so, it would not surprise me if we do this or something like this from here. Again, that's all of this will be predicated on what it can do before a crash. If it's the crash, then we will have a lot of wait time on our hands, just like I showed you on those long-term charts. But again, still solid assets overall. If you are nicely profitable on anything and you want to ensure that you for sure keep those profits before that, then you can sell those and capture those profits while you know for sure that you have them. We don't know when the crash will happen. We know that things are massively overextended. We know there's massive speculation happening right now. We know the frenzy is at a fierce pace. We know that people are pumping up stocks over tweets, and rappers are getting interviewed about stocks, and rappers are investing in cryptocurrency companies, and like all these types of stuff is the stuff that happens near tops when something goes from professionals being involved to the least experienced person being involved in those markets. When you get to that point, you are in the final innings of that bull market, and when it cracks, it's a big one. So just know that. So if you're up a good bit, 10, 15, 20%, whatever, something on most anything I would say except for SLV. And again, if you're in SLV and want to sell half and insure that, even you can do that. But so LPL has got a big gap between the price and its 200-day moving average. So it would not surprise me at all if we saw something like this or something like this. Again, barring a crash. So that's what I'm looking for there. CAJ, again, I'll move through these pretty quickly since I took so much time on the crash part. Trust me, you'll be glad when you did, because I guarantee you, your broker's not teaching you stuff like that, and they're not pointing out stuff like that. Because if I taught at a brokerage house what I just taught, there'd be people putting a lot of their money in cash and possibly even taking money out of their accounts. And brokers don't want that. It doesn't meet any of their goals. So they're going to tell you to stay fully invested at all times. Or if you, or yeah, you can take a little cash. You can have 5% here or 10% cash or something. They're going to tell you something really, really small. Because again, it just goes. It's them first and you second. It's the way it really works. They're not going to say that, but in reality, that's the way that world works. And so it does not behoove them to tell you to go to cash or anything of that sort. So CAJ has been again on quite a recovery from 15s to 24s, but it's getting stretched far away from the moving average. By the way, you've got your golden cross here. It would not surprise me to see some sort of pullback, something like one of these couple of scenarios before heading higher. Again, if we do get the crash, then all of these LOA counts can change. So here we've got wave one, excuse me, which could either be in a leading diagonal wave one with a bigger wave two to come, which is always possible. If so, you get something that comes down quite a bit more before heading up again. Or you can get a 5-wave sideways consolidation, which where you go through A, B, C, D, E, and then up. So that can always happen. It won't be compressed in this small of a time, but that's all the space I've got that I've given myself to work with. But again, defensive stock there, and I expect it to go to higher highs. So after KHC, we've got ticker symbol E. So again, wave one, wave two, we're in wave three. With this likely having more to go. By the way, WTI crude, wave one, wave two, wave three. Brent crude, which is what a lot of the rest of the world uses, wave one, wave two, wave three. So if you were going off of, this is why I say we don't go off of political agendas. I don't say what does Biden want, what are the Democrats want, what does Congress want, and then invest accordingly. Because guess what? If I'd have done that, we wouldn't have been in any oil stock, would we? Because who would think oil would go up under a Biden administration when he hates oil and he wants only renewables? So, so again, but we followed the trend of oil and fundamentals, and E has gone from 11s to 22s, currently at 20.69. And then we've got, of course, SLV. We bought when it got slammed. Again, downtrends are our friend. So when this got slammed in here and in here, we used those slams to buy and to average down, and that's why you were up so much. Most people are not up nearly what you were up on SLV, because there's no way you couldn't have paid them to buy this at 15 or 12 or 11 or anything like that. And so, because again, your average retail person will not buy stocks when they're going down. They feel bad about them when they go down, and they're emotional investors. And so why should they buy when they feel bad? And that's the way they think. So they think, I feel good about something when it's going up, so I'm going to buy. So when it goes from 1086, where you can't pay them to buy it, and it goes to 27, now they're interested in buying it. Now that it's almost tripled up on its value, now they're interested in buying. And that's the way people do a lot of assets. Again, you couldn't get anybody in Bitcoin at 3,000, but you can't keep them away from it at 30,000. Another huge bubble. Okay, so SLV. This one, because of the way day traders got into it, and shot it up here, and then they came out of it when it didn't move near enough for them. I don't like that activity because normally I would say this is going up here, and I believe that it is. But with them disrupting what would be the normal flow of stuff, could it come back down here, or could it do something deeper before? Absolutely, any of those are possible. So if you want to sell half of your SLV, if you haven't, to ensure that and put a stop at break even or something like that, you can definitely do that if you want to. And that way it ensures a gain on that. Then we've got XOP. So because remember we sold PPLT. So XOP wave 1, wave 2, in wave 3 right now. Again, an oil asset, a bunch of oil stocks in XOP. So again, this one can move a long ways in a little amount of time. Went from 28 to 70 here, went from 38 to 72 here, with I believe more to go in wave 3. So so I'm seeing this do like that, but could it possibly have a larger ABC correction before that happens? Yep, sure could. So either one of those scenarios could unfold. By the way, the commodities have gone through a secular bear market. That means it's not just a temporary, down for a year or two or whatever. Like it spent a long time down. That's what secular bear market is. Cyclical bear market's like where it spent a little time, weeks, months, a year or two, something like that is a cyclical bear market. It's shorter in duration. So commodities last peaked out back in what was 2008 before 2009. And they went through a big, massive ABC long secular bear market up until basically right now. And so I believe that we are likely in the next bull market of that, with this being probably a major wave 1. And keep in mind we can have wave 2 pullbacks well, this is so this would be a wave 1, this would be a wave 2 type of pullback, which they can go down further than that. But still, nonetheless, a bull market, meaning that this would be the bottom, and overall it would head up from that point with its rises and falls along the way. So, and then we've got the dollar, which had been rising for the last so many years, and is now in a bear market, contrary to headlines that you read. So, people ask me, why's the dollar in a bull market? It's not, and they're seeing the headlines, but they're not charting it. So, so it was in a bull market for a number of years. You'll remember in this region and in this region, I talked about how the dollar was overvalued and should reverse. And here it did temporarily, and then here it kind of double topped, and then here it finally reversed. So I had the season right, but not the the exact of it. But I knew it was the drum was beating a little too fast there, and it was about to stop. So so here's your 1, 2, 3, 4, 5, and now we're in A, and then you'll get some rally up at some point, B, and then C. Also know currency trends and downtrends can last a really long time. Now this one is probably one of the larger ones, but the dollar index went from 121 to 71 before it was all said and done. Also know dollar recoils can be fairly swift, and they'll feel like a bull market, is beginning again, but they're not necessarily. So, so for instance, this B wave up here went from 80 to 92, so it's pretty good move. And this was, some of these rallies here feel pretty sharp at the time as well. And then this ultimate one, went up, but again, it really based, for some years there before it really took off again. So we're back in a bear market in the dollar. We're back, I believe, in a overall commodity bull market, secular bull market in commodities, secular bear market in the dollar, and that's very good for our type of stocks. So our type of stocks may not fall as much as I showed you in the past because of those dynamics, but you want to be every bit prepared for if they do fall as much as what I showed you in 2000 and 2008, that you don't get scared, you don't get out of hand, you don't get emotional, you don't say this is taking too long. Guess what? The market doesn't care if you think it's taking too long. So what you say by practicing those thoughts is you're practicing impatience, and money goes to the patient. So Warren Buffett says it this way, and I probably ruined the quote by sharing it on the forum today, but that money is constantly going from the hands of the impatient to those of the patient, to those that can keep their head about them when everybody else loses theirs. Guess what you get to choose? You get to choose which category you go into, the impatient or the patient, the lose your head category or the keep your head category. You get to choose that. I don't choose it for you. Nobody else chooses it for you. No other LI subscriber chooses it for you. Now, we can all collectively help you keep your sanity about you, but it is your job. It's not my job. It's not. I will help you. I've preached it the whole time. I've prepared you better than probably anybody that I know that runs any newsletter service or anything out there has prepared you. But again, it's up to you to keep mindful of this stuff. If you got to replay this video during the bear market, please do. I might even title this one a little different so it's easier to see, and not delete this weekly video so that it stays around through that bear market. But so with us having the dollar overall on our side, again, there will be rallies up on the way down, and having commodities looking like they have turned a quarter, heading to the upside. That's overall good for us. So that would help energy stocks, metals, all kinds of things like that we own over time, and foreign assets that we own like EWW, LPL. There's a lot of different things, CAJ, that can benefit from the decline of the dollar. Meanwhile, it's going to get ugly for a lot of people because their stock market portfolio is going to decline and they're going to panic. Their dollar is declining. Foreign money is going to go back home and away from the U.S. stock market. Commodity prices are going to go up, so that means food prices at the grocery store are going to rise. Gas is going to rise at the pump because, after all, you're seeing oil assets rise. And so their expenses are going to get greater. Their portfolios are going to go down, and they're going to be in panic mode, and they're going to be in chaos. And guess what? It's your job to not join them in the party. So just know that it's your job to stay the logical investor and not become the emotional investor. Because if you become the emotional investor during that time, you're going to make stupid decisions that you regret. Let me give you a prime example while we're talking about that. So I had I can't remember if it was a lady or a man. I believe it was a lady in this particular instance. That so let me go back on this chart of Bed Bath & Beyond. So I had a lady who had been with me in this, and it had gone up and down and up a bit and then down again and went down lower. And right in about here, I remember it vividly, right in about here, she sent me an email, said, I'm canceling my subscription. You're wrong on Bed Bath & Beyond, and basically she's going to lose her butt for it. Okay, so one, if that's the case, then she didn't diversify, like I said, and she put too much money in one basket, which I teach that emphatically. So she didn't do even dollar diversification. And two, she went back to the emotional side of investing, which is whatever I see, I feel and believe. So here you feel good about stocks, here you feel bad about stocks, here you feel good about stocks, here you feel bad about stocks, etc. And so what you see and how you feel has zero to do with what the future holds for that stock. Now, I couldn't emphatically tell you that Bed Bath & Beyond turns around at 3 and goes up, but what I can tell you is that our portfolio overall would come off those lows and rally up higher, and they did. And so no sooner than she had thrown in the towel and locked in her losses on Bed Bath & Beyond, which again was her own doing, and I could not talk her out of, because again, she thinks she's right and I'm wrong. But and think about how silly that is. Some professional that's been watching markets for 25 to 30 years, she's new at this, she's inexperienced at it, so she pays me to get advice. Then she thinks she knows more than I do, and then she pays me for advice that she doesn't take, locks in her losses, and walks away. Now that's ludicrous. I mean, that's like me telling a plumber, a bricklayer, an electrician, an IT person, or whatever, that I know more about their job and I don't have any experience in it. How insane would that be? How ludicrous would that be? But people do that all the time in the stock market. They'll think they know better. and yet they have no experience hardly or very little experience, or either they didn't do good on their own. And then they come to somebody who has been around it for a long time and who does keep that level head, who does stay focused on fundamentals and is not emotionally motivated and does it and allocates in an institutional type way, but thinks that their stocks aren't supposed to go down ever because of that. And that's just not how things work. Meanwhile, this goes down another buck or so, bottoms at 343, doubles quickly, goes to sevens, then tens, then 11s, 13s. We cash out at 1920, around that area, and it goes a little bit higher, no doubt, and then it starts to sell off. And that sell off would have likely have continued had the Reddit crowd not got involved. And of course they did, and it pumped it from 17 to 53, which we could have never known that was going to happen. But the tail end of a bull market parabolic move is the most dangerous place you could ever be. So while this feels good to see this go up like this, in a blink, in a couple of days, it went from 53 down to 24. So it would have cut your position in half, in its gain, and it's still probably going to go much further before it's all said and done. So it feels good, but it's the most dangerous part of the trend is the tail end of it. So that's why you don't want to try to squeeze every little ounce out of the tail end. You want to capture more on the low end and get position, and that's really where you'll make most of your gain from buying in so low, not from selling out so high. This is the not so dangerous part. This is the absurdly dangerous part right here. And so people will go, gosh, should have stayed in it longer because X happened. No, for starters, you didn't know X was going to happen. And secondly, when it does, you also don't know when the end is going to be. And if you did know when the end was going to be, you would be Warren Buffett or Bill Gates by now because of being able to squeeze out 100% of a trend. Nobody can do that. So solidify it within yourself that I can't call a bottom, I can't call a top. That means me and you both. But I can take a good bit of meat out of the middle of it by assessing when fundamentals are strong and low risk and low PE, and when they get to be higher risk and higher PE. And that I'm gonna focus most of my gains right in here and not try to get the last little bit of that out, because when that thing turns, people deceive themselves and they'll say, yeah, but I'll know when it turns and I'll get out. They do not know when it turns and when it gets out. They said that on AMC as it went from 4 to 20 and back down to 7, all within just a few short days. Do you think they knew when that trend reversed, and it bit them like a dog? And same thing on GME. It goes up. And by the way, corporate insiders are selling like a big dog when these things are happening because they know that their companies aren't worth anything near like that, and so they're selling and getting rich off of it, as they should. I mean, they should sell something that's grossly overvalued. And it goes from 483, and the intraday high was 513, and it's all the way back down to 53.50 now. So imagine the drop. So while this feels exciting, again, imagine the drop within just a few short days, not weeks, not months, not years, from 483 to 53.50. So, and I mean, just today it was down 42%, just today, one trading day. So that's why we avoid bubbles, because while people think they can get rich overnight, what you're going to find is they give usually all of that back and then some. And by the way, do you think most people got in here or here? No, they got in here, 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 here. So they got in from about 300 to 500, most people, and then now it's down to 53.50. So what kind of loss do you think that is? Massive. So that's how you blow up retirement accounts. That's how you blow up regular brokerage accounts with greed and reckless abandon. We do not do that. We are in for the long game, the long haul. We are to be investing as long as we want to be doing it in our lives. And you don't do that by taking restless bets and gambles. You don't turn Wall Street into your casino. If you do, you're going to get bit like a rabid dog, and it's gonna spank you hard. So don't do that. So lost my place where we were before that. So we went to, I know we went to XOP, and this said, we go back to our 1 year chart. XOP, and I believe it's going up into the 80s. We've got FXY. Type that in right. FXY had been trickling up. I said it probably was overdue for a pretty sizable pullback. We're seeing that now. Could go a little further, so not saying it won't. So we either see something like that, or we see something that does something like this. Either way, that's what I'm looking for with the yen. Again, it's one that stands the chance of actually going up within the downtrend. Doesn't mean that it has to, but it certainly can. We've got GDX. Again, move up looks like a double zigzag to me, wave 2 that looks like ended here. And if that 3308 holds, then we've got a wave 1, 2, and this overall wave up, wave 1, wave 2, 3, 4, 5, something on into new highs. So that's what I'm looking for. Now, if this materially fails below that, then of course we could have a bigger double zigzag wave 2, which could take it on back further before heading higher. Just know that can happen. So that's my scenarios of what I see for GDX, barring a crash coming before then. So on IBM, wave 1 or wave 1, wave 2, either way, and I believe on into wave 3. That's the way I see it right now. So then we will likely see it go either here, or we could we could see it do something like this. That's what I see is likely to happen there. On the shorter term charts, it looks like it's trying to turn around and head up already. So we'll see. It does have one higher low on more intraday charts. ExxonMobil. So I've really got to think about this one because we may never get the chance to own an 8% dividend stock again, because most stocks that have that kind of a dividend yield are either in a lot of trouble and they can't afford to keep their dividends, so they have to cut their dividend, which that's not the case with Exxon, especially with rising oil prices. But their cash is enough to support their dividend, cash and earnings. And they've stated that they're going to recently that they're going to keep their dividend. So to have a fundamentally sound company that's not through the roof overvalued or have a ton of downside risk and be very high yielding, that's a rare gem right there. And that's one of the reasons why I believe institutions are pushing this up so much, because I believe a lot of institutional money is going into it because they know the bear market's coming. If they got to sit in a bear market, they'd just soon earn 8% a year while they're doing it. While they wait it out, where everybody earns 1%, 1.5%, 0.2%, etc. So that's massive in a low yield world. So here's wave 1, wave 2. We're in wave 3 now, which has more to go because wave 3s go higher than wave 1s. So I'm looking for this to head on up, but you could get some kind of larger, 3-wave pullback to some degree before that happens. I mean, these kind of scenarios could happen. So just know. So 1, 2, and then we're in 3, which should ultimately go higher. But again, there can be some pullbacks within that wave 3, and then on up further in wave 3 before you get to another pullback in wave 4. So that's ExxonMobil. CAH. So CAH has been in somewhat of a range. I gave more of a chart on that in the forums that had all kinds of markups on it that you can look for in there. I mean, there's an immediate range that's like right in this area, that even has really a more recent, like even tighter range within it if you want to get technical. So there's a lot of compression in here, and those tightenings and coilings cause big breakouts to come out of them. So that could either, and by the way, their earnings are tomorrow morning before the bell, so that doesn't have to be, but it could be a very big catalyst for this to shoot out of this range one way or the other. And nobody knows ahead of time which it is. Now, if you were all in, you need to have this stock for sure go up out of this range. The beauty of the way we do stuff with our allocation, we're okay with either way. If it breaks out to the upside, then we've got our one batch that's invested that takes off and gets a quicker profit. If it breaks out to the low side, either here towards the 200-day moving average, or much deeper here towards the low end of this range, or anything like that, we've got the ability to get in and averaging down if it gets low enough before turning around and heading higher. Um, so again, that looks so much more favorable. What I do like is there was a major higher low here than this major low here. We have hit 57, 58-ish resistance a number of times here, 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 and 56 is right in here, so pretty close to that. So anyway, once it can bust through that, whether that's more immediately or whether it takes another pretty good sized dip before it does it, it could ultimately have a pretty sizable, big move higher there. And again, it's in the health industry, and so is fairly defensive in nature. Not meaning that it can't go down, because remember I showed you CAH earlier, but that it can rocket up a lot once it's done. So another reason why I liked it is because there's a lot of long-term support right in there, which is not a mile away from where we bought it. Also because it looks like there is either like a three-way flat or a five-way sideways kind of range going on there, that to where the bulk of this is in that I believe is poised for likely another move higher. But again, if we get some kind of breakout that takes it lower first before higher, that's fine too. So it's fundamentally sound, fundamentally cheap, pays a decent dividend, and we don't care either way it goes. It can be the faster route or it can be the one that takes a little longer, but we have more money engaged in it, so we get a bigger dollar return and a bigger percentage return. So wouldn't hurt my feelings if a lot of our stocks went down more before they went up, because that's how you get more fully invested. And we do have some stocks that we do not have fully an investment in, and that, guess what, a downtrend would assuredly get us fully invested in those stocks at lower break evens than what we have now. So that's why downtrends are our friend. They are not our enemy. They're your enemy if you're fully 100% invested. They're your enemy if you're 100% invested and trading on margin. They are not your enemy if you have bought value stocks and you bought good companies, solid companies at cheap valuations, and you have cash available to deploy at certain strategic wide levels like we do in our portfolio. So downtrend is your friend there. That's why Warren Buffett says, I love it when my stocks go down. And he's not getting old and senile. He's getting old but not senile. The reason why he says that is because exactly for that fact, because as it goes down lower, he acquires more of a better thing at cheaper prices. And then when it goes higher, because again, he's the patient guy, right? As it goes higher, he reaps and money transfers from the people who were impatient to the hands of the patient. So, by the way, it's very scriptural. There's all kinds of scriptures about being patient, about not being impatient, about keeping your head about you, about not being a person of anger or fear or greed, etc. So again, this is all biblical principle. So if you follow biblical principle, you won't lose your head, do stupid stuff, and you will go through that and come out the other side a wise person. So the Bible says that a prudent person sees danger ahead and prepares. So I've prepared you, knowledge-wise, how to handle things emotions-wise, cash-wise, defensive stuff-wise, quality of asset-wise, dividends while you wait-wise. That's all you can do as an investor. Anybody that's running billions of dollars in a hedge fund, mutual fund, things like that's as good as they can prepare for something like that. So just know that's how that will roll. And everybody's portfolio, including the Oracle of Omaha, Mr. Warren Buffett himself, that will happen for. Here's his Berkshire B shares right here. If I can get them to pull up, my screen's going blank there. So the B shares, which were the baby Berkshires, the B class shares, went from 55 to 27 in 2000. They went from 101 to 44, and they went from call it 230 to 159 in that market correction there. So even the Oracle of Omaha himself, Warren Buffett himself, his portfolio goes down by a lot during those times, and he has to ride through those periods, but he earns dividends along the way. He's patient, and guess what? They go to higher highs for him, and he makes money over time. Why? Because he doesn't make excuses and say the system's against me, the system's rigged, everybody's out to get me, whatever. By the way, they don't say that when they're winning, when they're doing good. They only say that when they're losing, and they ignorantly say that because It's them and their thinking that is defeating themselves, and they think it's some external force, and it's not. If you think right, and if you keep your head right, if you stay non-emotional, and listen, you will make it through that bear market and on through to greener pastures, and you will not suffer like other people suffered in it, and you will have good things that you can say about it looking back through it, whereas everybody else, is sour grapes to them. And after these crashes, you can't hardly get them to look at stocks or invest in stocks again, and you're still on to making more money again in the next bull market. And many of you implementing the dividend capture strategy and got you another stream of income going during the next bull market, etc. So stick with it and keep wise counsel, which is in this case me. That's not haughty to say that, because if I've been looking at something for 30 years, if I'm not wise and smart in it, then something's wrong. So I would not say that about something I had very little experience in. And listen to some people that are that are on the forum that are old enough to have lived through these crashes, that can tell you that what I'm saying is absolutely true, and that I'm giving wise counsel and advice in that. So anyway, that's it for this week. Thanks so much for watching, and God bless. Bye bye.